Hello everyone, welcome to the 110th episode of me learning how to trade in Forex. So in the last episode we went through how to create a mechanical trading system. Basically mechanical trading systems are systems that generate trade signals for a trader to take. So they're called mechanical because the trader will take the trade regardless of what is happening in the market. Therefore this should eliminate all biases and emotions you're trading because you're supposed to follow the rules of your system no matter what. Goals of mechanical system. 2 goals when developing the mechanical system. Your system should be able to identify trends as early as possible. Your system should be able to avoid you from getting whipsawed. So yeah. And now we're on to design your trading systems in 6 steps. So design your trading system in 6 steps. The main focus of this lesson is to guide you through the process of designing your own Forex trading system. While it doesn't take long to come up with a system, it does take some time to extensively test it. So be patient. In the long run, a good Forex trading system can potentially make you a lot of money. Very good. Step 1, time frame. The first thing you need to decide when creating your system is what kind of Forex trader you are. So step 1, time frame. Decide what kind of Forex trader you are. Are you a day trader or a swing trader? Do you like looking at charts every day, every week, every month, or even every year? How long do you want to hold on to your positions? This will help you determine which time frame you will use to trade. Even though you will still look at multiple time frames, this will be the main time frame you will use when looking for a trade signal. So this will help you determine what time frame you will use to trade. Even though multiple time frames will still be looked at, this will be the main time frame you will use when looking for a trade signal. Step 2. Find indicators that help identify a new trend. Find indicators that help identify a new trend. Time frame. Since one of our goals is to identify a trend as early as possible, we should use indicators that can accomplish this. Moving averages are one of the most popular indicators that traders use to help them identify a trend. Specifically, they will use 2 moving averages, one slow and one fast, and wait until the fast one crosses over or under the slow one. This is the basis for what's known as the moving average crossover system. So the fast one, the fast moving average is the blue line, slow one's the orange line, so we can see that the blue line's always been on top of the slow one. So, but then this bit crosses over, so notice after crossover the pair begin a nice downtrend. Very nice. In its simplest form, moving average crossovers are the fastest way to identify new trends. It is also the easiest way to spot a new trend. Of course, there are many other ways Forex traders spot trends, but moving averages are one of the easiest to use. Moving averages are one of the most popular indicators traders use to help them identify a trend. Specifically, the use of a slow moving average and a fast moving average, and wait until one crosses over or under another. Step 3. Find indicators that help confirm the trend. Step 3. Find indicators that help confirm the trend. Our second goal for our system is to have the ability to avoid whipsaws, meaning that we don't want to be caught in a false trend. The way we do this is by making sure that when we see a signal for a new trend, we can confirm it by using other indicators. There are many good technical indicators for confirming trends like MACD, or moving average, convergence divergence, stochastic, and relative strength index. So finding indicators that help confirm the trends. Ensure when spotting a new signal for a new trend, this can be confirmed using another indicator. So downtrend, relative strength index overbought, sell signal, moving average, convergence divergence, downward crossover, sell signal, and then when it's uptrend again, relative strength index oversold, buy signal, moving average, convergence divergence, upward crossover, buy signal. As you become more familiar with various indicators, you will find the ones that you prefer over others and can incorporate those into your system, i.e. MACD, stochastics, RSI. Step 4. Define your risk. Define your risk. When developing your Forex trading system, it is very important that you define how much you are willing to lose on each trade. You must define how much you're willing to lose on each trade. Not many people like to talk about losing, but in actuality, a good trader thinks about what he or she could potentially lose before thinking about how much he or she can win. The amount you're willing to lose will be different than everyone else. You have to decide how much room is enough to give your trade some breathing space, but at the same time not risk too much on one trade. You'll learn more about money management in the latest lesson. Money management plays a big role in how much you should risk in a single trade. A trader should always think about the potential losses before thinking about the potential gain. Always think about the potential losses before the potential gain. Step 5. Define entries and exits. Define entries and exits. Once you define how much you're willing to lose on a trade, your next step is to find out where you will enter and exit in a trade in order to get the most profits. Entries. Some people like to enter as soon as all their indicators match up and give a good signal, even if the candle hasn't closed. Others like to wait until the close of the candle. Okay, nice repeat. One of the Forex traders here in babypips.com, Pipsurfer, believes that it is best to wait until a candle closes before entering. He has been in many situations where he will be in the middle of a candle and all the indicators match up, only to find that by the close of the candle the trade has totally reversed on him. It is all just a matter of trading style. Some people are more aggressive than others and will eventually find out what kind of trader you are. For example, in the chart below, this trader's entry was when the candle closed below the support line. Shorted at market, you could either choose to enter as soon as all your indicators match up and give a good signal even if the candle hasn't closed. you could also choose to enter after the candle has closed. In the chart below, this trader's entry was when the candle closed below the support line. So support SL at 1.4625, breaking below the support line, shorted at market. Right, okay. For exits, you have a few different options. One way is the trail stop, meaning that if the price moves in your favor by X amount, you move your stop by X amount. Another way to exit is to have a set target and exit when the price hits that target. When exiting, you can either trail your stop or have a set target. And exit when the price hits that target. How you calculate your target is up to you. For example, some traders choose support and resistance levels as their targets. In the chart below, the exit is set at a specific price, which is near the bottom of the descending channel. Trailed stop to that, shorted at here. Should that be take profit, TP at? So that should be take profit because that's at the support level, right? Near the bottom, yeah, so that should be TP at 1.4515. Others just choose to go for the same amount of pips, fixed risk out on every trade. However you decide to calculate your target, just make sure you stick with it. Never exit early no matter what happens. Never exit early no matter what happens. It's up to you to decide how to calculate that target. However, make sure to stick to your target. Never exit early no matter what happens. Stick to your trading system. After all, stick to your trading system as you develop it. One more way you can exit is to have a set of criteria that were met will signal you to exit. For example, you can make it a rule that if your indicators happen to reverse a certain level, you would then exit out of a trade. Could also make rules for exiting, such as if one of your indicator reverses to a certain level, then exit the trade. Step 6. Write down your system rules and follow it. Write down your system rules and follow it. This is the most important step in creating your trading system. You must write down your trading system rules and always follow them. Discipline is one of the most important characteristics a trader must have, so you must always remember to stick to your system. No system will ever work for you if you don't stick to the rules, so remember to be disciplined. Oh yeah, did we mention you should always stick to your rules? Always follow your system. How to test your Forex trading system. The fastest way to test your system is to find a charting software package where you can go back in time and move the chart forward one candle at a time. When you move your chart forward one candle at a time, you can follow your trading system rules and take your trades accordingly. Record your trading records and be honest with yourself. Record your wins, losses and average win and average losses. If you're happy with your results, then you can go to the next stage of testing, trading live on a demo account. To test your trading system, find a charting software package where you can go back in time and move the charts forward one candle at a time. We move your chart forward one candle at a time. You can trade your system, you can follow your trading system rules and take your trades accordingly. Record your trading record and be honest with yourself. Record your trading record and be honest. Record wins, losses, average wins, average losses, if you're happy with your results, you can go to the next stage of testing, trading live on demo accounts. Trade your new system live on a demo account for at least 2 months. This will give you a feel of how you can trade your system when the market is moving. Trust us, it is very different trading live when you're back testing than when you're back testing. After 2 months of trading live on a demo account, you will see if your system can truly stand its ground in the markets. If you are still getting good results, then you can choose to trade your system live on a real account. At this point, you should feel very confident with your Forex trading system and feel comfortable taking trades with no hesitation. If results are satisfactory, then practice the system on a demo account for at least 2 months. The end goal is to feel very confident with your Forex trading system and feel comfortable taking trades with no hesitation. Build your trading systems in 3 steps. Now that you've learnt the basics of technical analysis, let's now combine all this information and build a simple trading system. This should give you an idea of what you should be looking for when you develop your own Forex trading system. This system is a moving average crossover system, which uses moving averages to determine whether to go long or short. Additional technical indicators are also used for confirmation before entering a trade. You'll learn to use these various technical indicators to establish specific crystal clear entry and exit levels. The trading system can be built in 3 simple steps. Define your time frame, define your entry trigger, define your exit trigger. 3 steps. to build the trading system. Define time frame, define entry triggers, define exit triggers. Trading setup. Trade on a daily chart, swing trading. 5 simple moving averages applied to the close, 10 simple moving average applied to the close, stochastic 1433, RSI 9. So this is the trading setup. So we got the time frame, which is swing trading. We're trading on a daily chart. Set to find indicators to help identify a new trend. So that's the 2 simple moving averages. Find indicators that help confirm the trend. So that's stochastics and the relative strength index. And then the other ones I've not said. Define entries and exits. Trading rules. Entry rules. Enter long if this 5 simple moving average crosses above the 10 simple moving average and both stochastic lines are heading up. Do not enter if the stochastic lines already in the overbought territory. Relative strength index is greater than 50. Enter short if the 5 simple moving averages crosses below the 10 simple moving averages and both stochastic lines are heading down, and do not enter if the stochastic lines are already in oversold territory. Relative strength index is greater or less than 50. Exit rules. Exit when the 5 simple moving average crosses the 10 simple moving average in the opposite direction of your trade, or if the relative strength index crosses back to 50. Exit when the trade hits stop loss of 100 pips. If the daily chart is too slow for you, you can try experimenting with different time frames. Keep in mind though that the faster the time frame, the higher likelihood for false positive trades. These are trades that meet the rules of an entry but where you end up getting stopped out. So remember, the faster the time frame, the higher the likelihood of false positive trades. Remember, a trading system is only effective if it is followed. You need to have the discipline to stick to the rules. Okay, let's take a look at some charts and see this baby in action. Which time frame should you trade, or what time frame should you trade? What time frame should you trade your system on? The smaller the time frame, the more difficult it is to develop a successful system. In other words, developing a system to trade on a 5-minute chart is more difficult than developing a system that trades on a daily chart. Interesting. The smaller, I'm assuming it's because there's going to be more false positive trades, which is why it's going to be harder to develop. The smaller the time frame, the more difficult it is to develop a successful system. In other words, developing a system, there's a lot more noise on the smaller time frames, as there's a lot more noise on the smaller time frames. Given the massive amount of data you would need to test the system over the years and years of different data, it can be a challenging task. Smaller time frames often mean less profit per trade and less risk per trade. Smaller time frames often means less profit per trade and less risk per trade. It is a good idea to strike a balance between your trading account size and the risk you are willing to take. Remember to balance out your trading account size and the risk you're willing to take. The new trader's trap. Let's take a look at what's called the new trader's trap. The smaller your trading account, the smaller the time frame you should trade. The smaller time frame, the more difficult it is to trade. Do you see the trap here? New traders often come into the trading world with very little cash, hoping to make a quick buck. So they trade small time frames because they think intraday trading is a way to make money. They start trading on a 1 minute or 5 minute chart in hopes of scalp the market a few pips here and there. By doing so, they suddenly put themselves in a very difficult spot because they are trading a very difficult time frame when they are least experienced. They set themselves up for a quick fail. It is much easier to develop a profitable trading system on a daily time frame than on a 5 minute chart. It's much easier to develop profitable trading systems on a daily time frame than on a 5 minute chart. Because of this, we recommend that new system traders build trading systems on daily charts. It doesn't matter if you ever plan on trading those time frames, you do it to build confidence and skills in developing profitable systems. Because you are more likely to develop a profitable system on a daily chart than a 5 minute chart, you should start on a daily chart. Why bang your head against the wall and discourage yourself? Build your confidence and skill level and then move on to more difficult intraday time frames. True. So it's recommended to that new traders build trading systems on daily charts to begin with. Should you scalp? Scalping something that intrigues many system traders. The challenge of taking small consistent trades from the market daily while risking very little is appealing. With scalping, it is generally expected that you are trading from a small time frame, probably 5 minute or less. The idea is to open a position, capture only a few pips of profit. The appeal is since we're trading from such a small time frame, your risk is small, which means you can trade with a small account. Often you will have setups that produce high win rates and occur more frequently than setups on a higher time frame such as hourly or daily. There tends to be a higher frequency of trading opportunities for scalping, which can potentially lead to large accumulated profits versus your starting account balance. Scalping for the retail trader is very difficult to do. Almost all retail traders who try to scalping will fail. If you're new to trading, we wouldn't recommend it. Why? When trading in these time frames, you are competing with high frequency trading firms running automated trading programs built by a team of PhD brainiacs. It's like a basketball newbie trying to play LeBron James. Other significant barriers are the transaction cost in both the spread and slippage. When you're competing with high frequency trading firms running automated trading programs built by a team of PhD brainiacs. Other significant barriers are the transaction costs in both the spread and the slippage. The difference between what a buyer will pay and what the seller will receive at a given point in time is referred to as bid-ask spreads. Your broker buys from you a lower bid price while selling to you at a higher ask price. The bid and ask prices are your broker's quoted prices or quotes. Scalping for the retail trader is very difficult and isn't recommended for beginner traders, as you're competing against high frequency trading firms running automated programs. Other significant barriers are the transaction costs in both the spread and slippage. The difference between what a buyer will pay and what the seller will receive at a given point in time is referred to as a bid-ask spread. Bid-ask spread, the difference between what a buyer will pay and what the seller will receive at a given point in time. Your broker buys from you at a lower bid price while selling to you at a higher ask price. The bid-ask prices are your broker's quoted prices or quotes. The bid-ask spread is used as a proxy for transaction costs. Buys from you at a lower bid price and sells to you at a higher ask price. So, for example, if they're selling an apple, they would sell it to me for... Oh no, they'll buy an apple from me for, I don't know, like £5. If I do sell it to them. But then if I'm trying to buy an apple off of them, then they're going to charge me £10. So the difference between these two is £5, so they would make a £5 profit for every trade I do with them, basically. The bid-ask spread is used as a proxy for transaction costs. So the bid, wait, let me just write this. The bid-ask prices are your broker's quoted price. The bid-ask spread is used as a proxy for transaction costs. The quoted spread measures the cost of completing a round-trip buy and sell order if trades are executed at quoted prices. The quoted spread measures the cost of completing a round trip, so buying and selling order, if trades are executed at the quoted prices. So that was the Apple example I think I gave. Basically, if I were to sell an apple to them, I would get £5. But then if I wanted to buy the apple back from them, then I have to give them £10. Yeah, so they would give me £5 if I sold the apple to them. Then if I want to buy the apple back, I have to pay £10. So at the end of the day, I lost £5, which is the bid-ask spread. The bid-ask spread is used as a proxy for transaction costs. The quoted spread measures the cost of completing a round trip. Yep. Transaction costs for a single trade are often measured as half the spreads. Transaction costs for a single trade are often measured as half spread, are often measured as half the spread If you're paying a 2 pip spread to enter an exit trade and make a 4 pip gain, 50% of your profits are going to pay the spreads. Scalping means smaller profit per trade, yet as you drill down to smaller and smaller time frames, your costs remain fixed. Scalping means smaller profits per trade, yet as you drill down to smaller and smaller time frames, your cost remains fixed. What? So, scalping means smaller profit per trade. But as the time frame decreases, your cost remains the same. Your cost remain fixed. Costs remain fixed. So there's still going to be that 50% of your profits are going to pay for the spreads. Is that what they mean? If you traded on a slower time frame like a daily chart and made a 400 pip gain, you'd pay 0.5% of profits to pay the spreads versus 50% in the previous example. That's a big difference. Oh, I see. If there was a 2 pip spread, but if you made 400 pips on a daily chart, there you only have to pay 2 pips, which is what, 0.5% out of 400. Whereas if you have a 2 pip spread but then you only made 4 pips, then you have to pay 50% of that, which is pretty big chunk of your profits. That's a pretty big difference. As the negative impact of transaction costs and slippage grows, this takes a more significant percentage of your profits. Profit percentage from scalping is further decreased through increased transaction costs, which is the spread, the bid-ask spread, and slippage. It's further decreased and slippage. This takes a more significant percentage of your profits. A single pip of slippage is hardly noticed when you're holding a trade more for several days with an average profit of $100 per trade. However, on a scalping system, a single pip is the difference between life and death. So basically, the shorter the time frame, the more difference a single pip or any movement is going to make to your trade. So the smaller the time frame, the bigger a difference a movement of a single pip is to your final. The smaller the time frame, the bigger the difference a movement of a single pip is to your final profit. The smaller the time frame, the bigger the difference a movement of a single pip is to your final profit. Does that make sense? The smaller the time frame, the bigger the difference a movement of a single, bigger the impact. The bigger the impact a movement of a single pip is to your final profit. Then throw in latency, computer issues, internet issues, and your margin for error is tiny. Latency, PC issues, internet issues, etc. Again, on larger time frames, you can exit trade now or in a few seconds, and it won't matter that much. Not so in the scalping world where everything is hypersensitive and your margin for error is tiny. The margin for error is tiny in scalping, whereas compared to larger time frames, error is tiny in scalping compared to larger time frames. In closing, if you're new to building trading systems or don't really already have strategies trading live on the market that's making money, focus on building systems on a higher time frames first. Don't already have system trading live on markets that's making money. Focus on building system on higher time frames first. Yes, gotcha. Okay, I'm going to leave this episode here then. So in the next video, we're gonna continue on with this. What's it called? Creating your own trading system with the so easy it's ridiculous trading system. So thank you all for watching. I will see you guys in the next video. Peace.